Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. So the One Big Beautiful Bill Act, as you know, has been signed into law. And the business favorable tax provisions that are included in OBBA are about to foster one of the most business-friendly environments that we've had in the United States in many years. Take a look at this example. You decide to buy a computer for your business. You decide to buy a phone or a tablet. You purchase a work vehicle. You purchase office furniture like a desk, like a chair, like bookcases and other equipment. Let's say these are all assets you purchased for your business in 2025, specifically after January the 19th, 2025, because the new rules related to bonus depreciation aren't effective unless the assets were purchased after this date right here, for whatever reason. But that does give you most of the year, and it certainly does give you the remainder of the year since OBBA has been passed. So just for example purposes, let's say that the assets purchased were a computer for $3,500, a tablet and phone for $3,000, furniture for your business of $5,000, and a work vehicle for $38,500, leading to a grand total of assets purchased of $50,000. Now, pre-OBBA, under the original 2025 tax law from the Tax Cuts and Jobs Act, you would be allowed bonus depreciation on these items equal to 40% of the cost. So let's go down here to this pre-OBBA bonus depreciation calculation. There are the total assets purchased for $50,000. There is the 2025 bonus depreciation rate under the Tax Cuts and Jobs Act, that's 40%, leading to bonus depreciation under the prior law for 2025 of $20,000. Now let's just say for this example that you are starting up or ramping up your business for the year because you realize that multiple income streams may be critical to the retirement plan for your family. And so you realize that there is no time like the present to expand upon the traditional 3 pillars of retirement with a 4th option that has the potential to provide you with significant monthly cash flow during your retirement years. As you can see right here, the 3 pillars of retirement income are typically number 1, Social Security, number 2, the balance in your retirement accounts, and number 3, pensions if you have one, or annuity income, which is basically just a personal pension that you purchase. But for many folks who wonder about the future viability of Social Security, or who may be concerned that they currently are not projecting to have enough in their retirement accounts to live the lifestyle that they desire in retirement, or who may not have pensions lined up and may not have the ability to purchase annuities right now, the 4th pillar of retirement income may be one of the most attractive options you have to set up for yourself now. Not only can the income from a business provide you with cash flow during your retirement years, but it can also be utilized right now to fill up those retirement accounts as much as possible. It can be used right now to purchase those annuities that provide stable and guaranteed income in retirement. There are many reasons why people are considering building out the 4th pillar of retirement income in the uncertain economic times in which we live. So let's say for this example that you're just getting started in your business and you generate just a small amount of revenue for 2025. Let's just say $20,000. Now, pre-OBBA, your business tax return would look something like this. You have revenue, as we just said, of $20,000. You had purchased these assets over here, and we already calculated that bonus depreciation on those assets would be $20,000. So we bring our expense for depreciation depreciation. Over here, that's $20,000, resulting in net income or loss for the year of 0 for this particular business. Okay, so now that your business return is complete, your personal tax return, Form 1040, would look something like this right here. Let's just say that all your other income from other sources like W-2 wages, interest, dividends, whatever, that's $80,000 for this example. Now here's your business income or loss that flows through to you from your Schedule C, which is your business tax return. The phrase that they use in the tax world is flow through this business income, which happens to be 0 in this case. But regardless of what it is, it flows through from your business return onto your personal return right here. So in this case, as we said, the business income or loss was 0, leading to AGI of 80,000. There's our standard deduction. I'm just going to say it's 32,000 for purposes of this example. Obviously, this number could be different based on your age and your filing status, as well as what year we're talking about, but let's just go with 32,000 for illustrative purposes. So 80,000 minus 32,000 standard deduction leads to taxable income of $48,000 in this example. Now under OBBA, which you are well aware of, bonus depreciation for 2025 is now back to 100%. So if we go down here to our revised bonus depreciation calculation, the total assets purchased are still $50,000, no change there, but the 2025 bonus depreciation rate under OBBA is now 100%, leading to bonus depreciation of $50,000 now, as opposed to $20,000 that we saw in the previous example when the bonus rate was only 40%. So now coming back down here to your business tax return, you still have revenue of $20,000, no change there. But now when we bring our depreciation expense over here to the business return, we have $50,000, leading to a net loss from this business of $30,000. And then on your personal tax return, Form 1040, it would look something like this. This $30,000 would flow through down here. So we'll start with all of our other types of income. That's still $80,000, no change there. There's the business loss that we just talked about, $30,000. That leads to AGI on your personal return of $50,000. There's our same standard deduction that we've been using of $32,000. And the result this time is taxable income for the year of $18,000. Up here, when the law was 40% bonus, we were looking at $48,000 of taxable income on the personal return. Down here, now that bonus is back to 100%, we are looking at taxable income of $18,000 on the personal return. But I want to think beyond just reducing our taxable income in the current year. On this channel, we have been talking about multi-year tax planning. We have been talking about minimizing your effective tax rate over the course of your life. It's never just about 1 year in isolation. You might get a benefit here and then get hammered in retirement if you don't plan appropriately. The point of tax planning is to lay out your projected numbers for the entire course of your life, both the working years and the retirement years, and to figure out where the most beneficial opportunities lie. They may not just be in the current year, they may be in the future, they may be from shifting income out of the future and putting it into the current year. So going back up here and thinking more about this $30,000 of deduction, which is available to us under this fact pattern under the new law with OBBA, but which was not available to us under the previous law with Tax Cuts and Jobs Act. This $30,000 right here, it gives you the opportunity for what? And the answer is to potentially absorb more income. For example, doing a Roth IRA conversion and getting that retirement money out of a pre-tax retirement account and into an after-tax retirement account where it will no longer be vulnerable to the greedy whims of a future Congress. Now you might say, wait a minute, I don't understand. Why don't I just take advantage of this $30,000 deduction now? Why would I want to do a Roth conversion and offset this potentially with $30,000 of income? Well, the answer to that goes right back to my personal tax planning template program. Nowhere on this chart have I discussed what tax bracket you are in. But if you take a look right here at only $18,000 of income, we are down in the lowest brackets. If in the future, way out over here in RMD years, we are going to get bumped up into the highest brackets of our lifetime, then we have room right here to absorb income and fill the lowest brackets. And that's why from a lifetime effective tax rate, if you have the opportunity to shift income out of high bracket future years and into low bracket current years where that income can be absorbed, you have the potential to save tens if not hundreds of thousands of dollars in tax, just depending on the size of the numbers you're working with in your personal situation over the course of your life. By the way, if you haven't seen my video on the One Big Beautiful Bill Act and Roth IRA conversion planning, here is what the thumbnail looks like right over here, and you can find a link to that video in the description below this video on YouTube. If you want to protect your family's retirement money from the greedy whims of a future Congress, this 40-minute video right over here was made for you. Okay, so now going back to the example, you've got a $30,000 business loss flowing through to your personal tax return Form 1040, and you could use that loss to offset a $30,000 Roth IRA conversion, for example, and you would be in exactly the same tax position as you would have otherwise been pre-OBBA. So to illustrate that, here is the pre-OBBA tax return from above, which had $0 of flow-through business loss since bonus depreciation was limited to 40%. You can recall this one from above, we had $48,000 of taxable income on the return. Now right over here, this is the post-OBBA tax return where the $30,000 flow-through loss can offset a $30,000 Roth IRA conversion and still give you the same pre-OBBA taxable income. So going down here, the only line that I have added from the previous example is this Roth IRA conversion line. We still have the $80,000 of all other income. Now we have $30,000 of Roth IRA income. There's our $30,000 business flow-through loss. The combination of those three leads to AGI of $80,000. There's our $32,000 standard deduction, and the result is $48,000 of taxable income. The exact same amount of taxable income that we would have had pre-OBBA before the law was changed to allow for 100% bonus depreciation. So one way you might look at this situation right here is from the point of view of equivalence. You have reached equivalence in taxable income on this return and this return, even though over here you were able to get done another $30,000 of Roth conversion. So if you're a business owner or an aspiring business owner that wants to make an investment in your future, OBBA would literally give you a free quote-unquote $30,000 Roth IRA conversion in the fact pattern above, simply by investing in yourself and thus, in turn, investing in America. There is no better time to make an investment in your family's future and secure that fourth pillar of retirement income than when 100% bonus depreciation is the law. Some Americans will take advantage of it and some won't. What can I say? Now, what about Section 179? Because I know there is at least one person watching who's like, what's the big deal with 100% bonus, bro? Like, I can just 179 those assets and still get the full deduction. Now, if you heard that and you're like, what in the world are you talking about? Then let's break it down super simple. Section 179 is just another way to write off the cost of the assets that you buy for your business. For example, if I go down here to this business tax return, we have $20,000 of revenue and I am offsetting that by $20,000 of bonus depreciation. Alternatively, over here on this business tax return, I have the same $20,000 of revenue. This time I am offsetting it by $20,000 of what's called Section 179 deduction. Again, that's just another way to write off the assets that you purchased for a business. In this case, you can see that both the bonus depreciation as well as the Section 179 deduction end up resulting in the same amount of net income or loss of zero for this business. And also, it's true that pre-OBBA, the Section 179 rules did not limit you to 40% of the cost of the assets. For example, under the pre-OBBA rules for Section 179, you could write off 100% of the cost of the assets. There is a certain limitation on 179 as far as the total amount that you can write off, but it's in the millions of dollars, and so that's probably not applicable to most small businesses. Alternatively, for bonus depreciation, you could only write off 40% of the cost of the actual assets, just like the examples that we went through earlier. And right now, under the post-OBBA rules, both Section 179 and bonus depreciation, you can write off 100% of the cost of the assets. But here's the big difference between the rules for Section 179 versus bonus depreciation. Section 179 can't create a loss. So, for example, even with $50,000 of assets to write off, bonus depreciation would allow this $20,000 of revenue offset by $50,000 of bonus depreciation, resulting in a net loss flowing through to your personal return of $30,000. On the other hand, Section 179 only allows this revenue of $20,000, therefore the Section 179 deduction, even though there's $50,000 that could potentially be written off, the deduction for that particular year will be limited only to the amount of revenue that you have. Basically, you can only go down to zero right here. You can't create a loss. And if you can't create a loss, then that loss can't flow through to your personal return, where it could offset other types of income you might want to absorb, like Roth IRA conversion income, for example. So the long and short of it is that the reinstatement of 100% bonus depreciation for 2025 creates the perfect environment for any American that has been thinking about building up that fourth pillar of retirement income to help secure your family's financial future. By the way, if you want to make 2025 the year when you start building out that fourth pillar of retirement income by taking advantage of the most advantageous portion of the United States tax law, which is the portion applicable to small business enterprise, My Business Taxes Intensive Training is a comprehensive video program designed to take everyone from beginners to those who already own and operate a business through the detailed world of business tax planning. We are going to cover all the major write-offs that are available to small business owners, as well as some of the specialized types of retirement accounts that are not available to individuals, but are available if you own your own business. If you want to build up that fourth pillar of retirement income, these specialized accounts give you the potential to sock away up to 10 times more than an individual contributing to a traditional or Roth IRA. In addition, we are going to cover the complete process of starting a new business or taking an existing business online. One of the biggest gripes I hear from small business owners is the ongoing struggle to find new clients or customers, to market your products to them, and to engage with them in an automated way. As part of the Business Taxes Intensive Training, we're going to tackle these ongoing issues faced by so many businesses, which will make the tax planning portion of this course relatable to the real world instead of feeling like it comes out of a textbook. Finally, as part of the program, we will be taking all of the business books and records and learning how to incorporate everything into TurboTax so we can prepare and file our Schedule C business tax return. The program includes all updates that will be rolling out between now and December 31st, 2025 due to the business law tax changes coming out of OBBA. So it's an incredible, comprehensive business tax training for which I have received a lot of great feedback. You can join the Business Tax Intensive Training Program at the link in the description below this video on YouTube. Everybody who joins gets lifetime access to the program for a one-time access fee. You do also have the option to bundle the program with the personal tax planning template because after all, your goal here is to build up that fourth pillar of retirement income and get as much money as you can socked away into Roth designated accounts, either through contribution or conversion, so that it is safe from the future meddling of a greedy Congress that is looking for ways to quietly skim off money from your vulnerable pre-tax retirement accounts. As I said, the link to join the program is in the description below this video. So that's going to be it for today. Thanks for watching. I hope you enjoyed today's video, and I'll see you next time.